We are now hitting the lows of 2022, and volatility is really the name of the game here.
Today we're talking about market volatility.
I believe I was asked about the markets today. I'm sorry people are losing value in their portfolios.
Jerome Powell is raising interest rates, stocks and assets are dropping, people are losing money in their portfolios. I've lost a ton of money in mine. Market volatility is a huge topic in the news.
Inflation, higher interest rates, and the Ukraine war are setting the stage for a big financial crisis.
When stocks take a steep drop, investors can come face to face with a bear market.
Let's talk about what a bear market is and why that's relevant.
This second option is called buying the dip. Markets are volatile, and in this environment, buying the dip can be risky.
What is buying the dip? Should you buy the dip?
The watchword we're going to have for the year 2022 is going to be volatility.
Hey guys, what's going on? We're back. Today we're talking about market volatility. Jerome Powell is raising interest rates, stocks and assets are dropping, people are losing money in their portfolios. I've lost a ton of money in mine. Market volatility is a huge topic in the news. I've also seen some headlines which to me aren't necessarily correct, or I wouldn't necessarily agree with them. So we're going to talk about those today. If you're on the channel, like and subscribe on the channel. If you're on the blog, you can use your email address. Also make sure you follow us on all socials. Now let's dive into volatile markets. All right, so let's talk about what volatility is, and more specifically, let's talk about what volatility is as relates to the stock market, because that's why you're here and that's what you really care about. In the securities market, volatility is often associated with big swings in either direction. For example, when the stock market rises and falls more than 1% over a sustained period of time, it is called a volatile market. In assets, volatility is a key factor when pricing options contracts. Now, so let's make that real. Bitcoin has been going up and down and has been in the news a lot. And so volatility, Bitcoin is a good example of what volatility looks like. It was in the 30s and then it went up to the 40s or the 50s. And now I think it's down around $20,000 and $18,000. And so those wild swings where you can't really predict what the asset is going to do, and there's not really enough historical data to really predict which direction the market is going to go in or what the price is going to be. That's what volatility looks like in today's market. Let's talk about what a bear market is and why that's relevant. A bear market is when a market experiences prolonged price declines. It typically describes a condition in which securities prices falls 20% or more from recent highs and widespread pessimism and negative investor sentiment. Bear markets are often associated with declines in the overall market or indexes like the S&P 500, but individual securities or commodities can also be considered to be in a bear market if they experience a decline of 20% or more over a sustained period of time. And the reason why we're talking about stock declining as well as the bear market is because in a bear market, or when stocks are dropping, everybody has an opinion on various things to do. And so we're going to look at some of the reactions from CNBC, the Wall Street Journal, and then I'm going to give you my opinion on what I think about them.
I believe I was asked about the markets today. I'm sorry people are losing value in their portfolios.
When stocks take a steep drop, investors can come face to face with a bear market. Stocks enter a bear market when they lose at least 20% of their value from a recent high. Let's look back at the 2020 chart. You can see when the market started to fall in February. It entered a bear market here, just under a month later. The term is a shorthand way for Wall Street to mark when stocks have taken a tumble, a sign that investors are anxious about the future and moving away from risky assets.
Another really important factor is the economy. Often bear markets have been affiliated with economic recession, so that's one thing that can really put investors on edge.
Recessions have accompanied 9 of the last 17 bear markets. And while one doesn't necessarily cause the other, problems in the economy can be a major factor in bringing stocks down.
All right, so as you can see in a bear market, some investors say, hey, it's time for me to dump stocks, or it's time for me, I need to rethink my strategy. There's typically a sell-off. Some people end up holding. And that's when these news and media outlets decide to give you their opinion. So let's start with the first one, which is buying the dip. Should you buy the dip? What is buying the dip? Let's dive into that, and I'll explain that really quickly.
When markets get choppy, investors can pull out to save their money, or they can cast their lines for discounted stock, aiming for a bigger profit later on. This second option is called buying the dip. So far in 2022, buying the dip hasn't paid off as well as in the past. Markets are volatile, and in this environment, buying the dip can be risky.
What we're seeing is that after people step in to buy the stock market dip, the S&P 500 has kept falling the day after. So that means that you're sitting on a loss pretty quickly.
But even these circumstances haven't stopped investors who want to bring in a big catch.
All right, so let's talk about my opinion on buying the dip. Is it a good strategy for your portfolio? Well, it depends on the type of investor you are. If you've been following this channel for a long time, you know that I preach DCA, dollar cost averaging. And if you don't know what dollar cost averaging is, let's do a quick refresher, and I'll just pop up a quick definition right here for you, right? That's when you consistently buy into the market. An example of that is like every 2 weeks, you have discretionary $1,000 at your leisure, or after you pay all your bills, and you take that and you put it into the market. That's a consistent way, a passive way of investing, and that's what most people recommend. That's what I recommend. That's what Warren Buffett recommends, especially if you don't plan on spending your days looking at various strategies, trying to analyze companies. That's a simple way to have average returns on whatever the stock market is doing without really having to put a work in. For most people, I wouldn't necessarily recommend buying the dip because you don't really know like if the market's going to continue to go down or go up, and nor are you consistently looking at charts, analyzing companies and really trying to figure all of that out. However, there is a good time to buy the dip. I'm a salesperson, so when I come into like a lump sum of money, there are times where I have a lump sum of money to put into the market. What I typically do is I still dollar cost average in. And so yes, when the market dips, I'm like everybody else, I get emotional. I'm like, oh, like, you know, Baba's cheaper than what it was. Google was at 3,000. Now it's at like 2,300. If it goes back up to 3,000, like I'm the same way. But what I won't do is take a lump sum of money and just throw it in the market. What I will do is I'll dollar cost average in. Let's say I got $12,000. It's an easy example. I'll take $1,000 every month and I'll just start putting that into the market, and I'm watching for the trends. I'm seeing whether the market's going to go up or it's going to go down. If I see the market trend going up after a couple months and it's out of bear market territory, meaning that the stock market dipped 20% and then I'm seeing it coming back out of bear market territory, that's a good time for me to put like a larger lump sum in. Maybe I'll put like $2,000 in and I'll wait that week and I'll see how it goes, and I'll put like $4,000 in. And remember, these are all like short-term strategies in order to just maximize my long-term returns, meaning that I'm not going in and out of the market, I'm going in the market. I'm just trying to maximize how much stock I actually buy at any given time. I came across this video from CNBC titled, "There are reasons for investors to consider buying the dip here." And that was in January, and the stock market has tanked since then. So obviously, clearly, they were mostly wrong in that, right? Investors shouldn't have been buying the dip, or shouldn't be taking like lump sums of money and putting it into the market. But let's watch that video and I'll give you my opinion on it.
Guys, good morning to you both. I mean, we have major averages all down significantly again this morning. The S&P down another 2%. 42.95 is the level there. Jeffrey, I'll start with you. Is there more pain to come? And I ask that knowing that this is a week with a trifecta of news potentially between earnings, the Fed, and also all the geopolitical risk that's simmering as well. I mean, are there certain signals that you're watching for to know that we are hitting a potential bottom in this correction right now, or what would you be looking for?
I think earnings are really important, but we're also going to be getting economic data here for the month of January starting to roll in, like the PMIs this morning, that are showing that Omicron is having an impact, negative impact on services. We've seen that in the numbers here. We know that in like open table reservation data. We're really seeing services really pull back very sharply. Of course, we know about the potential invasion of Ukraine by Russia and the looming start of a Fed tightening cycle. But I think if investors begin to shift their focus out a little bit, and they may this week and next week, given the earnings releases, they want to look to a brighter Q2. The rebound from Omicron in Europe, given pent-up savings and fiscal stimulus and inventory restocking. I'd note that Russian conflicts in Europe have not led to sustained stock market sell-offs in the past. And I think that there's reason for investors to consider buying the dip here. They may want to favor, however, buying European and value stocks that have led when interest rates were headed higher in the past.
As with most things, right, Jeffrey isn't necessarily right. He isn't necessarily wrong. And I know that's a wayward answer. This is a January video, so it's easy to like look back, right, and be armchair expert. So stocks still had a ways to go. Yeah, like Omicron is definitely affecting the market. I would be very, very cautious going into the market if you're dollar cost averaging, that's okay. If you have lump sum of cash, I'd probably hold off and just dollar cost average until we see where the market bottoms out at, and then I'll start purchasing. So I think he was wrong to tell people to just buy the dip, especially if you have like a large lump sum of money, because it's not time to buy the dip when the market's dipping and trending in the opposite direction, meaning it's going down. If you're a stock picker or you're someone who's looking to invest more into the market, now's a good time to start putting together your list. So when markets are going down and you're in a bear market, good time to do research, right? There's less exuberance around like, hey, buy this stock, oh man, it's going to the moon, like all that bullshit. And it's more time to do like fundamental like stock valuing and thinking about what you want to invest in long term. Here's some examples of what I'm investing in, right? Google, as you guys know, I work for Google. I have a ton of stock options already with them. But with that said, I've continued to buy Google because I think their fundamentals are really good. Google had great earnings. They're continuing to grow. YouTube was outpacing Netflix. So that's one company I'm investing in. Baba's another that I'm investing in. And so now's a good time to really sit down, look at those companies, look at the fundamentals, look at the 10Ks, look at the annual reports, and think about where they're going to be in like 10 years and invest more in those companies. I've still been dollar cost averaging into the market because the market is still trending downwards for the most part. All right, so let's talk about takeaways from this video. Bear market means the market's going down. Most investors sell off. If you're not a sophisticated investor, but you still want to take advantage of what's happening, you could dollar cost average, but just lower the amount that you're dollar cost averaging. That's a good strategy. I'm doing that like right now. I'm like DCAing just a little bit than I normally do, and then I'm stacking up cash. And then as the market continues to dip, when I see a stock that it hits a price point that I really want, that I think is going to be a good value investment, then I'll buy that, right? One company that I've done that with is Baba, which is a Chinese-based e-commerce company. Another strategy is do not buy the fucking dip or just listen to all these analysts, right? They don't know your portfolio. You need to understand that you're in this for the long term. Buy the dip is almost like a reactionary thing where you're like, oh, the market's gonna go up. The market doesn't always go up. So what you should be doing is looking at the longer trend of the stock market. Like if it's trending downwards, not saying that you shouldn't be investing, but invest less so you can take advantage and buy more stocks at the bottom. The third thing I would say, this takeaway, is that CNBC was mostly wrong. Don't be buying the dip. Dollar cost average. Watch the market. As the market starts to go back up and you see a trend over the next couple months, then you can start buying into the market at a larger dollar value. And once again, that's going to be based off the stocks that you have picked or the stocks that you want to invest in that you've done some research on. All right, if you like stuff like this, if you found this video helpful, you can hit the like and subscribe button. If you're on our website, you could put your email address in and subscribe to us, and make sure you follow us on all socials. We will see you in the next video.